Okay, what is going on? SmartHelping.com here. I'm Jay, and it is 10:35. I'm a little late today. I had some work going on, but it's okay. We're going to get into the fun part of the integration phase, which is doing all the financial statement linking up. And I am very excited to to finish this one, and then again next week we're going to be doing brand new models. So before I get into it, let's get our link out to Twitter. Sound check. Out to Twitter. Sounds good to
Sound
me.
check.
Live modeling now. Vending machine. Forecasting. Financial statements. Okay. So remember this template I'm upgrading is from smarthelping.com. It is the in the industry specific bundle as well, right here. Um, so this is the one we're upgrading. And remember, you can buy all kinds of financial models and tools at smarthelping.com. Check the financial models tab at the top. You can get everything I've ever built for $9.99 or buy by category below. I've done hundreds of different things, all unique, all super valuable. If your business uses Google Sheets or Excel for anything, you will find value here. Alrighty, let's jump in. So yesterday we got everything cleaned up, got all the logic imported that we need. We are going to have a little bit of hiccup with the exit because this CapEx schedule is a little bit different. Um, because we have this logic here, but we also have the purchase of the vending machines happening on its own schedule with depreciation. So I have to think about how I'm going to integrate that, which we'll get to. But first, let's start with the income statement here. So we want to reference our monthly detail tab, um, revenue, and we don't need to differentiate. These are all just revenue from selling things out of the vending machine. And remember, we're going to do cost of goods sold here directly. Uh, Let me think actually. This is really good at planning out the unit economics. You can figure out, okay, what's a profitable vending machine? What do the vending machines look like? What's the average sales price? And then how many are you going to have over time with the deployment and up to 3 different types. And then you could figure out, what that looks like as far as initial equity required and returns. Um, okay. For cost of goods sold, we're going to have to do inventory based on, I believe I can do this number. Let me think. So this is doing the total purchase, the max amount that could possibly be sold, and then that will just deplete as it's used up. And note there's going to be some waste because not everything is sold. And let me think about that. So if you buy, you're buying the stuff to fill this many max sales, you've got some waste. This is your actual sales. So when this sells, you have waste and cost of goods sold. All right, we'll have to think through that more when we get to that as well. Okay, so revenue, cost of goods sold here, I'm just going to reference the monthly detail, cost of goods sold. And then we have our gross profit margins. You've also got all your different expenses here. So let's see, I believe I separated, yeah, so we've got sales and marketing. We've got general and administrative. Now there's some variable costs in here like refill, deployment, vendor royalties. Did we put R&D in here? Yeah, I did. You probably won't have R&D, but you might. All right. And then, oh, whoops. 92. Okay, yep, that's good. And then startup costs. Okay, so that was fine. Let's drag this over. Okay, there, depreciation. Now here's where we have the first trick. So I need to add a depreciation item here. So let's insert also on the annual insert, and we want this to be vending machines as a whole group. And that depreciation is going to be based on this matrix schedule here, this number, starting in period 1. Okay, so there's that. Then you've got taxable income. Now, you can see here we're scaling. We eventually get to be profitable and then exit. Let's add it here as well. Okay, so we're matched. So income statement, that's all we really need to do for the income statement. Everything else is lined up and this matches, so that's great. Uh, let's see, balance sheet. So inventory is going to have to be, we'll deal with, well, okay. Let's put that in here. So really we just got to change the sum ifs on the income. Oh wait, this is already linked up. So row 14 is cost of goods sold. So you can define how long how many months you're going to buy inventory for. That's driven here based on your cost of goods sold. That's how much you got to buy. And then on here, if I look at, so waste is just a function of figuring out how much I'm actually selling. It's not an additional cost. We're just saying we don't sell everything that we buy. So that's not a double count there. So the max sales, actual sales, but you still got to buy everything. But you don't sell. Okay, so that tracks. Inventory. Let's look at the cash flow. All right. Payments for goods sold. So inventory 1, this is good. 1, 2, 3, 4, 5. So that's working. Other OpEx. This is just going off of C25. So that makes sense. And then taxes. Okay, looking good. Net cash effect of operating activities, cash flow from investing activities, so CapEx, sale, business. Let's look at the terminal value. I believe it's fine because I do like terminal value here based on an EBITDA multiple. And that looks like it's calculating, let's see, row 28. Yep, that's EBITDA. So we're going to go trailing 12-month EBITDA times the multiple defined on the global control valuation. Now this is where we're going to get tricky because we also have the exit of not just these items, but also the vending machines. And we got to figure out how much of the sales price. Now we could say, we could separate it and say the terminal value here, that's based on a multiple of EBITDA. Some is applied to these CapEx items, some is applied to the just extraordinary income, and then some we could separate out the actual vending machines themselves as a separate line item. So you're saying EBITDA multiple plus the value of the vending machines plus, um, and then if you have like a building, which you may or may not have, probably not, but it's there in case you do. If not, you can zero it out right there in this top row for building. Yeah, we'll probably do a separate row here actually. This will probably be proceeds from vending machine proceeds from vending machines. And then we'll have a profit or loss there, which will have to flow over to the income statement as well. We'll just do a new row for that. So that should be fine. So that's good. That's fairly elegant solution. Uh, okay, so this is good. This is good. Let's say, all right. So how do we want to do this? Where do, we'll do it on the terminal value. So vending machine asset sales. Now technically you could just say if it's going to be part of this number, then you could just zero this out. But we'll put count at sale, which is just going to be max of monthly detail here. So 507 based on this deployment schedule. Let's just make sure this is 507. It is perfect. Man, this was a really nice model to figure out. Like, you really can see the cost of deployment. Those start generating revenue. You figure out how many more you can deploy over time and what cash that's going to take. Really nice model here. Where in the world was I? Oh, terminal value. So we've got count at sale. We'll just say average sales price per unit. Total proceeds from vending. Now this number will flow up to that. Let's say it's like let's say 2000. And we have to, all right, so let's go over to cash flow statement. We want to hit this full 1,014,000 here. Sale of vending machines. And this will just simply be, now if we are including the exit proceed, and it's the exit month, so we got to put an and in here. If that is that, and the month equals the exit month, if those things are true, pull the terminal value. And if those things are not true, then zero out. This is yes. If that equals that, then pull the value, otherwise zero. Okay, so we have that there. Now, borrowing of long-term debt, principal, and company stock. So here, now we need to format the monthly detail again to make it look nice, clear out all these empty spaces. So let's clear this out. 194 to 212. 194 to 212. We'll put other cash flow items here. Then we need to clear out, let's see, 201 to 218. Okay, and we have proceed. Let's see, this is going to be a black item. So we have other cash flow items. Uh, Let me see, did I put startup costs up here? No. Okay, so we've got startup costs. We have CapEx. We have purchases for the vending machines down there, so that's fine. Startup CapEx, proceeds from exit, proceeds from vending machine sales. Oh wait, this is here. We don't need this. Let's just clear this actually. Okay, so other cash flow, startup costs, CapEx, taxes will be in here. Proceeds from sale of business, proceeds from vending machines, if it's separate. Now, it's likely that this vending machine, this will be zero probably, and the EBITDA will include that, but you never, it depends on the situation and the sale, the deal. Every deal is different. So I'm just trying to make it as flexible as possible. Okay, and the reason why we have to do this on a monthly detail is because we're going to derive this as the minimum cash required after all of this is accounted for. All right, so startup cost, CapEx, I think that's everything. Vending machine purchases. Okay, so now to get these numbers, we just pull, so startup costs we'll put here as a negative, CapEx. Oh, it's doing that stupid thing. Come on. CapEx. Taxes. Proceeds from sale will go. Come on, Excel. This has been happening for like 6 months, and I don't understand what is the problem. Um, it's very annoying, and it's like sometimes it has issues referencing between tabs, and I don't know why. And it's like random if it does it or not. All right, let's try it again. Proceeds from sale. Oh, come on. It's frustrating. All right, we're just going to drag it down and adjust the reference. So this is sale is so 19, 20, and then 21. So this is 19 plus 20, and then this is going to be 21. All right, I believe that's all of those items. Okay. Now most people probably will be zeroing out taxes, but if you don't, they will be evenly spread over the year if there is a profit for that year. Startup cost. Okay, so now we go to cash flow. So it equals EBITDA. Now hold on. We got cost of goods sold up here, right? Yeah, so we want to add that back. So EBITDA plus cost of goods sold, and then plus funding proceeds, and then we got startup costs, capex, taxes, proceeds, and then minus the purchase of the vending machines. Now my question is, we have purchases happening in January? Hold on. No, sorry. This is inventory. What am I doing? What am I doing? Inventory purchases is a separate line item, which in this isn't working. I can't reference any other tab. So let's just manually do it. And that's cash flow. Oh, inventory. 10. So here's my inventory purchases. So that's where we add back the cost of goods sold, then take this out. But we also then have purchases of vending machines. Okay, there we go. Now that should be everything. So if we drag that over, that flows. Let's delete some more 209 to 212. This should match with that, which it doesn't right now, I know, but we'll have to update a couple things here. So, uh, like all of this. Okay. Bring that in. We have all these items here. Oh, we're still up by 321. What are we missing? Let's make some more. 200 to 202. Oh, am I off by a row? So this ended 198. 199 inventory purchases. Oh, we didn't add that one. So that'll be the difference. There you go. Although this was never dragged over all the way, so let's do that. Okay, perfect. So we match there. That's good. Now on the um, let's see, these work. Whoops. So this is fine. So we need to pull 210 as the minimum equity required. That's that number. And we go over here. Balance sheet. We're off on the balance sheet for sure. It looks like the inventory is good. Oh yeah, okay, so let's add vending machines to this. Also to the annual. And then it will equal, so vending machines is going to be, let me see, we have it. Let's look at the matrix here and see what we got for vending machine value. So I guess it's just sum of that. So total purchases and here plus the previous. Now my question is, so that's period 0. There will never be depreciation. Well, let's see how this flows. We might have to remove the option to choose period 0. Okay, so here's all of this. Accumulated depreciation looks like income statement. Okay, so this 34 to 49, it's got to go to 50 for that extra row. All right. Now what happened here? Plus that. And then we also put a slicer here. If it's greater than the exit month, then 0. Otherwise, if it's greater than the beginning month, hold on, is this even necessary? Okay, we do need, so we need the first part, which zeroes it out if we're past the forecast period. Okay, yeah. So if we were to go to end this a month early, okay, good. So that works. We are completely out of balance still, so we're missing some things. Looks like the purchases of the vending machines. So we have it here. Is it in the cash flow? Sale of vending machines, CapEx includes. Now, you know what? Yeah. So if I add this here, plus, hopefully we don't get a circular reference error. Actually, let's just go straight into this. And that's fine. Dang it. Minus. There we go. So that's fine, but we have to do a couple things. Number one, there's no more period zero. That's just not going to work. So period, the first month is month one, and that's when you have to, that's the earliest you could start buying these vending machines. Number two, if we go to the monthly detail, we're now double counting the cost. So 204 is not needed. That's all going to be in this CapEx item. So we can say included in CapEx row. All right, we're moving and grooving here. So save that. Also, annual detail, same deal. And now, what's going on now? We're still off. Let's see, I added it to this. Let me make sure this is the same. 13,512. No, it's not. Uh, oh, we never added sale of vending machines to this one. Okay, now let's check it. 14,526. 14,526. Okay, so this matches at least. Let's go to the balance sheet monthly. So we're out by the inventory or the purchase of vending machines, and well, it looks like we're just out by one. So are we offset? Let's see. Yeah, we are. Here's the deal. So there's no more period 0. So if I go to this, this essentially doesn't exist, so we need to start at D. Here, and then plus this. Now, this needs to be included in that bracket. All right, nice. So we're balanced. On the annual, we're missing, so let's just drag this down and it should just work. $844. So this 844, I believe that's going to be an issue with something with that profit I was telling the vending machines. Because, well, let's see. So on the exit month, oh, first of all, this needs to be updated. With this. Okay. So on that exit month, we have to account for the sale of the vending machine in here somewhere. And I believe it will just be counted as its own row. And we'll put net gain loss from vending machines. So we're selling them for $1,014,000, and I believe the cost basis at sale. Let's see. We can do index. We can get the accumulated depreciation for that. Match the end month with the month. So it's essentially saying we've had this much depreciation. We bought them. Let's see. Total purchase. We bought them for a total of monthly detail here. 7. So we're saying they're fully depreciated. I'm assuming we did a 5-year life, if I had to guess. Where did I put the useful life of these things? Here, 3-year useful life. So let's say 6, just so we can see what happens if there's something left. So, oh wait, total depreciation. Now hold on. If the useful life is 6 years, why are we seeing 956? And this should be, now why is this 17? Depreciation. Oh, I think I summed up the total purchases. Okay, so depreciation is in row 130. So that's one issue for sure. Oh wait, no, this is right. So this is the total purchase. Accumulated depreciation. Now the actual depreciation would be not row 32. I don't know what I put. It'd be this, 975. And you can see we're, well, let's see, hold on. We're changing things here in the middle. All right, so if I sold them for 1,014,000, I've had 975,000 of depreciation. Then I have a net gain loss of total sales minus, I guess the cost basis would be depreciation. I can't remember. Let me see what I do here. H minus I. So value at sale minus the book value. Book value is the total initial purchase price less accumulated depreciation. Okay. So if we go over here, what did I say? Total book value minus depreciation. So total book value would be um, cost basis. So I bought it for 1.7. Depreciation was 975. So actually, this is total purchase value cost basis at sale is then the total purchase amount less what's been depreciated. And now gain loss is difference between what you sold it for and what it's worth here. It's 234, and I bet you that's what we're almost out by that amount. Let's see. So if we do gain loss here, it's just going to be so if we're including, yeah, we're going to have to do this whole thing. So if and it equals the end month and terminal value is greater than 0, then if this is less than 0, meaning there's a loss, then just 0 out, there's no gain. Otherwise, give me the gain. Now, let's put that in. Now, what are we doing if? Okay, so we drag this over. We have a gain, so this goes into taxable income. Just add, oh, we could just drag this one down here. Now, actually, undo, undo, undo. So on taxable income, I did total sale business here, here, and then for cap gains tax, now I did this because it's different tax rates. So I did 56 times C31. I also want to say plus just so we're consistent in what we're doing here, plus 54. So there's that. Okay. Now we're still out here. We're out by 209,625. And so let's think. It's something to do with accumulated depreciation, I'm sure. Let's make sure we're not offsetting this. So sum income statement C34, C34. Wait, why? What? Hold on. 34 to 50. Hmm. So let's look at this. So 34 to 50. If I go here, this is starting in D, which is correct. Starting in D. This no longer would be a number. What are we out here? What are we out? We've almost got it. Um, so that's correct. This is just a tax calc. Oh, wait. I now have to add this back in. So we figured out the taxes, but we have to actually add this gain in here. Now that will definitely change this. It should. Okay, so now we're up by 443. And this is fun. So accounting for balance sheets, the hardest part is right now. This is the hardest thing is when you're not balanced and you're trying to figure out what to do. It's obviously it's something directly related to the exit only. It's not anything else to do with anything else. So um, we could start changing a couple things and see if the value changes. Let's say this is 3,000. Okay, so that's definitely a difference. 1.4, 230 went up 500,000, and then this went up a million. So it's doubling. Okay, so we're doubling something somewhere. Something's being doubled. Um, and it has to do with the exit. All right, so sale of business. Ah, this is it. So I'm actually adding D9 on the terminal value. We don't want to include that because we're separating it from, well, total sales, this can be here, but this needs to be sum of all the items actually be this and this. I believe. Wait, how are we more by reducing what? So D9, what was D9? Oh, no, 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 no. That was fine. So that's fine. D9 is here. You have these other items coming in, a total of 11,314. That's fine. So that's not being double counted here. Let's think. So we're adding the total cash flow there. On this, we're taking individual items. None of these include our extraordinary items. I think so. That. This is just a tax, and that's not including it. Somehow we're out by that 500,000 being double counted somewhere. Let's put this at 0. Now let's see what we get. 800. Okay, that does not help. I believe it's got to have something to do with this cash item. Or is something not fully... Oh wait, these are not adding up. Right, because we have to add this in. Add this in. This needs to add that. Okay. I don't think that really affects anything. No, 443. We're stopped by 443. Okay, let's look at retained earnings. We're going, this is something big here. So we're going from, we're increasing by 8.566 million. So if that's going up by 8.566, and on the income statement, it's that number, which is adding all of this stuff. Now this total is 9,110,000, which is just the gains, and that would be this number, this minus the cost basis. Other cost basis for CapEx. $415. Oh wait, $415. That's close. What could it be? What could it be? As I sit here and struggle. I'm gonna figure it out. I will eventually. Um, okay. I don't think it has anything to do with this. This is fine, but here's the tricky thing. If I zero this out, I still have a variance, which is odd. I still have a variance after that, so that means there's something else going on here that's off. Um, Sale of assets. So is this including the building? Where's this 2 million flowing to? Oh no, that's just a net gain. So the 990 is this, all these gains. When you add the total depreciation, 258, we have that, we have 732. Now this is 990 is the gain. Hold on, this makes sense. The total depreciation, let's just check that number, 258, which would be everything but the last row. Okay, so that matches. So that's reduced from the cost base. So when I sell the thing, I actually we get 2.4 million, 2.4 million, which is these two. However, the gain is 990, which is the difference between the depreciation and the initial cost against the value. Now I feel like I'm talking in complete circles and confusing myself. Oh, this is the pure trenches. I'm telling you right now. I knew I did not think it would be that difficult with this vending machine thing, but there's something just causing a hiccup here on the exit. Now, let's see, what if we don't include the terminal value in this and hit no? Okay, so then we're fine. Let's see, what about, well, no, that wouldn't make sense. Let's see, just to make sure. So if this equals no, then zero no matter what. Just so that is not going to cause a problem. All right, well, we're balanced if we don't have an exit. If we do, there's an issue. Even 804,375. What is that? And we're not even counting the exit of this here. This actually could always default to zero. Let's see, what's the value here minus this? 950, 625. And 950, 625. Hey, we're getting somewhere. So that's the total depreciation of the vending machine activity. Okay, we've got we've got something. So that's our variance is this, the value of the vending machines less the variance equals the difference. So what does that mean? What does that mean? So we've got accumulated depreciation zeroed out. But why are we out essentially? So if I were, let's just say to reduce this to this. Wait, that doesn't make sense. If we lowered, for some reason, so the accumulated depreciation is not hitting something on the exit. So I guess what it's saying is this total depreciation amount, 975, when we zero it out of here, we have to do other stuff because it's in here, then it goes to zero. So the balance, um, it has to hit somewhere. Hmm. We might not be able to separate this out. Yep. Okay. And so we're dang it. I don't know if I can do this correctly now. I was thinking we have to just define the percentage of the this proceeds that goes to extraordinary income, capex, and then for vending machines. Let's just say there's a 500 here. Rather, let's just say it's a big number. Okay, 5 billion. What did I put? I put 5 million. Oh, whoops, per vending machine. Hold on. Okay, hold on. So here we're up by 5.2 million, which now this again, so 5.2 million, is this the total depreciation? No. It would be, what's this minus 3,485? No, not that. Let's minus, what's that? Now, hold on. 5.4, that's nothing. Oh, for goodness sakes. All right, net gain or loss from vending machines goes here. This is simply this, which is the total proceeds So 2535 is what I'm getting. Is that what comes in here? Yes, 2535 comes in here on the exit. It affects the cash balance. So 25, let's just do like a T account. So you got 2.5 million increasing the assets here. Also, we're removing their full value here to 0, as well as the full depreciation. So this goes to 0, and the depreciation goes to 0, and then you've got a gain or loss based on the selling proceeds less the cost basis. Now on here, we're adding the gain only, which will increase cash flow. So question, on here, what do I add for the fixed assets? 2.415. On here, I'm adding this total. I'm only adding the gain for those CapEx items that are depreciable. I'm only adding the gain. Right, so that's the total profit. Wait, no. This is the total proceeds. 415. What's 415? 415 is determining the total value coming in. And then you've got the book value at sale is just the amount that's been depreciated against the initial purchase, and net gain or loss is the difference. So here, total value at sale is this number. We've depreciated 975. Yeah, let's go into this. So we did net gain or loss is, let's just copy this. I might have mixed up these. Let's look here. So net gain or loss equals value at sale, which is this, minus book value. Book value is the total amount of the purchase less depreciation. The total amount less depreciation is the cost basis. And then gain or loss is just that minus that. Same deal. Right? So if I did this over here, it would be value at sale is this number. Book value at sale is, again, the total value. Let's just double check that. It would be balance sheet 5 to 17. So taking this, which is just the amount paid. Okay, so amount paid would be this, and then you're subtracting the total depreciation in M. In this case, that would be here, and then gain or loss is just subtracting the two. 1755, which is that, and that amount goes in 990, which is right here. Oh, wait. And yeah, so 1.755 is that total gain or loss. The difference between these two is 780,000 is, so it hits assets in the net income based on the gain only. The, this is the cost basis. So the difference between these two is what should balance it out in theory. How are we out by 5 or 3.4 million? Oh, this is nuts, man. Oh, I have about had it. I'm so confused. Right, so the 780 would essentially be the difference between this and the accumulated depreciation. So that's where we're reducing the asset value by that difference. Well, no, we're here. We're just zeroing them both out. Let me pull up. Let me look at this e-commerce model real quick. I just want to make sure. Okay, yes, the exit is zeroed out. And look at these magically balance. Oh, come on. We're out by so much. Let's see. So monthly detail. Am I missing anything here? Let's see. This is 11.8 minus balance sheet. Oh, here we go. What's the balance sheet number? Ending cash 1576. And then what's our equity? Let's just make sure these are in line. If these aren't in line, then something is just off in general. So that minus this. Yeah, I think these are off too. Barely, but 117,000. Now, what could that be? So if I look here, if the balance sheet period, oh no, how is it going to work? Balance sheet period zero cash, or no, sorry, cash flow statement. We have this, and then minus sale of stock. We're at 1606, and here we do have a variance of 1036. Debt service. So, okay, so this is one thing that's causing a small issue. So let's fix that first of all. Um, I didn't add it in here, so minus this. Okay, now that's balanced. That's the other thing with the financial statements is when you have multiple things going wrong, it's very it's more difficult to figure it out because you can't just look for a number. See, that was easy. I could figure out, I could isolate the thing, and it was simply, okay, that was debt service. Now, I don't know if that would affect any of this. Do we at least solve the balance sheet for 0? Yes. Okay, so that's good. Now this 3.485 is a problem child. We have got a problem child here. Um, it's definitely directly related to this. Um, what happens if this is lower? It's just, who knows? It's off by a little bit more. Here we have a smaller gain. Okay, this is only off by 139. It seems like the issue is the closer. Let's see if we get this almost to 0. I have a feeling here. So let's see. This sale value, or what? Here, I just want to actually match this. So if this is 0, route 24,375. Now that number came up at 24,375. Hmm. Because now basically you're saying there's no gain or loss. It's an even scratch. We're still out though. Our depreciation is 950, 625. Like what would cost? Like I'm trying to isolate things. I don't know. Why is this variance? Is it like, is that 124? Hold on, 24,375 is 1 month's worth of depreciation. Okay, are we off by 1 month accumulated depreciation? That would make more sense. Let's go back into this calculation. Sum income statement C34. Let's see, this is 1,180,000 as of October. One million one eighty. We're out somehow by this. Now that could be a clue into what's happening here. So, uh, why are we out by that amount? And if we go, let's go to the last month of the 5th year. Wait, now it's not out at all. Hold on. What if we have a higher value here? Now we are 163.8, which is, I guess we're out by some difference between the accumulated depreciation and the gain somehow. What's that? 163.8. It's the gain or loss times 2. Is that it? Let's see. Go to 2000. 468. Yeah, it's the gain or loss times 2. So we're just double counting that. If we zeroed it out, it's now 780 is the cost basis. And so here we're saying the assets are lower. We know it's in cash, so are we double counting it in retained earnings somehow? Let's see. This is D9. It's not here at all. So the 780 cost basis. So if I were to look here, the 780 would be this in theory. This and it's same as that. Okay. So what if I essentially said if I sell them for 0, if they're worth 0, I take a loss on the cost basis. So this is a loss, and it's not showing as a loss though. Let me see if I just change this to not take the max and just let the loss go in. If this is just minus 780, in theory, that should come through here. Now what? Nope, now it's even worse. Undo. Even worse. So adding a negative made it worse. So this is basically saying I need to add the base value. If it's worth, but if I don't sell it for anything, I'm saying it's negative 780. So then in theory the difference should be the difference between this going away and the accumulated depreciation going away for that. is 975. So this minus 975 is the 780. So that's what I'm out by. What actually happened? I lost the cost basis. So it's 468. There's a couple things going on here. Number one, the gain or loss is being double counted for sure. Because look at this times two, it's 468, and that's what I'm out by total out. So it's being double counted somewhere, and I can't figure out where. It's driving me insane. This is tough, man. It's tough. I mean, where else could it possibly be showing up at? If I go to the monthly, I mean, this vending machine purchase, is this, we got inventory purchases. This is included in here. Let's say we zero this stuff out. Okay, so now we can really just see. I go to cash flow. This is 1,014. 1,014. Out by 468, which is double this. Oh dear. All right, let's try to look here. So what's affecting cash? We're getting plus 1,014. We're just gonna do this out one by one. So cash is going up by 1,014 in this month. What's happening here? The full value is going to zero, so we get a negative 1.755. They go out. So this goes down. So this goes up by a million. We lose the asset, it goes down by this. We also get rid of the accumulated depreciation up to that point, which sum of, oh, doesn't want to work. Let's just do it here. 975,000. Okay, so I've gained a million in cash. I've got rid of depreciation, which is a contra asset. I've got rid of the asset, so 780. So my cost basis essentially is that. Um, so net effect to assets is this 234, right? So assets go up by 234 net. Remove this, sell it for this, and remove the depreciation. What about on the equity side? Well, retained earnings goes up by this 234. So up, and that should be it. And assets equals the effect of liability plus equity, which is this. So in theory, both these should go up by 234. Now what's happening is something's gone up too much. Now I can look at this and say, you know, this 12,625,000, or sorry, the difference here is 9,463 is based on this and the total, and that's it. So this should, in theory, be correct, and that means that for some reason I've double removed the gain from the retained earnings somehow. So the retained earnings should be 468,000 more. And all this can equal, wait, what do we do here? If, so income statement 60, net income plus 52, which is the previous month, minus BK50. That's not relevant anymore to this type of model. 50 is not even a cell. So that's just essentially saying it's the net income. And I'm out by double the gain amount. I'm too low by double the gain amount somehow. So this amount, have we minused it instead of plussed it? Let's double check. I mean, that could, oh my goodness, this could be it. Is 54 a minus? Yep. Oh man. It was just a sign change. Oh my goodness. It was a sign change when I switched it, because this was already populated in 54. I don't know for what, it was blank. I just drug the call thing down. I was minusing it instead of adding it. Now look, we're freaking balanced. It's balanced. Well, that was horrible. I wasted so much time um, because of a sign change. Oh, drats. So this model, I mean, it's basically done, but I'm gonna have to clean it up tomorrow on stream. It's gonna take like a half an hour probably, or 20 minutes. Now the other question is, there was one other thing when we were earlier 1 month, there was an issue. Is that fixed? No. So we're out by the depreciation by 1 month, and I believe that's because of the offset happening here. Let me look. We should only be counting from D over. So this is 975. It should be 950. Why are we missing a 24,375 though? It doesn't make sense. So this is another piece of the puzzle, less complicated or less tricky, I believe. But for some reason, are we off or out by 1 month's depreciation of the vending? And it's saying, well, the asset's lower, and we know that's correct. That's the right amount. 1755, I believe. We can double check. Well, no, that's the right amount. In October we got 926,250. Oh, hold on, what's going on here? We're out. Ah, got to change the sign on this one as well. So 54 is a plus, not a minus. Okay. For the depreciation, 9. Oh, we can add these back in, by the way. Well, actually, let's keep the other CapEx out until we finish this. So, if we look here, man, an hour and a half. We are out by the 1 month's worth of depreciation. Now, what happens if this is 0? We have a negative, we have an issue because I believe. Now, if we allowed this to come through as a negative, let's see what happens here. Is that, nope. Yeah, so that works. Okay, I'm gonna allow this to come through as a negative if it so happens, which is fine. It just offsets the other amounts. But we're still out by this depreciation. Let me see if I move back another month. Sometimes this is how you got to figure it out. So if we go back let's go back to like June. Now this is out by 146 to 50. Now is that the remaining depreciation? Let's see, 7 months worth. It could be, or 6 months. Well, yep. Okay, so for some reason, it's not catching depreciation unless we end it on an even end year. Well, or the last year. Let's see if it works if we end it on this even year. Nope. And so that's doing, so we're missing depreciation from, why are we missing this? All right, so that's 682.5 is the retained earnings. It has to be picking it up because it's in here. It's adding it. That's adding that. Are one of these calculations, so 34 to 50, we updated it to include all of that. What in the world is going on with this, man? Every little thing is just causing a big disruption. I mean, let's go all the way back here. Let's go to like, let's say exit March. So this is like all the depreciation moving forward. Now, how in the world do we get out by that amount is my question. It's out by the remaining depreciation. Income statement E60. Hold on, let's move this up a bit. Let me go to the end of year one. 933,750. Okay, do I need to... Hold on, let's go back out. Let's go further in time. Uh, so it's actually easier to look at the last month. So here is 1 month worth. So I'm essentially out by the forward month depreciation, which is really weird. It's very strange. And I'm wondering, is it just that this needs to be zeroed out if we're past the end month? Let's just see. If, oh my goodness, it's yes. Oh, yep, that's it. Oh, I'm so frustrated. If uh we have to offset this, but it's okay if oh come on. Look at here's exactly what happened. On the terminal value, I'm summing up the total depreciation. I should only be summing up the total that's until the end month. That's it. Oh man. So sum ifs, depreciation. Come on. Well, I'm happy that this is solved. This is all will make sense now, which is great. If the Excel, holy crap, man. I need to be able to switch tabs, sum ifs. I only want the depreciation. Actually, this does stop. I just want this. There you go. Now we're balanced. Look at that. All set. And if we did a normal, let's say it was, we made a profit here. Go to balance sheet, all balanced. You could pick any month. So the issue there was on on this calculation, which was affecting the gain or loss, which was going over to the income statement, the depreciation I was counting was the total that happened no matter what. In reality, I should only be counting the total that happened up until the end month. So that's why I had an issue with the end month being different. And then the issue with the other part, the gain or the loss, was because I was minusing the gain or loss instead of adding it. So those two issues just cost me like an hour and a half, but hey, it's done. Now you don't have to deal with all that stuff if you purchase a template, it's all done for you and you could follow the logic along. We are all set. This works even in a negative situation. Let's put this back to how it was with 95% going here. Let's put some CapEx in here, random. Now normally you wouldn't be using much CapEx on this because a vending machine business, I mean, possibly vehicles is probably all, maybe some computer equipment. Um, but so this allows you to account for some of those things if you have it. And you can see now, looking good, all good, perfect. Now, if you're fully depreciated on these CapEx items, on if they're all fully depreciated at the end of your forecast period, then you just want to make the terminal value just be 100% extraordinary income. Other than that, this should be fine. This can be a negative, and it will flow fine. We'll have to do the sanity checks tomorrow, so I'll like, change the dates, put yes or no on the terminal value. I'll set all these up and check it. It might only be 15 or 20 minutes, but, well, could I do it now? I mean, I guess that's all that's left. Let's just do it real quick. Okay, so income statement, good. Balance sheets is in 61. Yep, that checks good. Annual detail against monthly. That will have to be updated to that. This is fine. We just need to update annual detail. Goes to J210. Or sorry, whatever's before J. It'd be this. That's good. Executive summary. Oh, we got to do this. We'll put a check down there. What was that, an H42? Let's do this. So, vending machine purchases looks good. Taxes, we have a new item on that. And Excel is just being a real pain in the rear end here. What was I doing? Taxes? This one. CapEx. That's that. Debt service. Startup costs. Exit proceeds. We don't have this one anymore. Let's do this and this. And then we have this one. I believe that's everything. So we go EBITDA. Oh, hold on. Inventory purchases. That's different now. No, 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 no. Inventory purchases here. This is basically the same as cost of goods sold, but it'll be offset a little bit. So this is 4457. This is 4457, but a little bit different. So we'll account for that. So we got EBITDA, add back cost of goods sold. Then we go plus here. We're going to have to make this row a negative. That's a negative, a negative. We'll have to make that one a negative. That's a negative. Add this, add this, add this, and that. All right, so what did I say we want to do? This is negative. Okay. Negative. Negative. Um, and this is put a negative on here. Okay. Now check. So the sum of, well, actually, the ending cash position here minus annual detail 1755. What is that? Vending machine purchases. Did I miss that? No, that's in there. 8,068,000, and what do I got here? 9. There's the vending machine purchases. Oh wait, this is weird. Why is this 0? No, vending machine purchases up here. It's in the, oh, I know. CapEx and vending machine purchases are in the same item. There we go. All right. So now we're balanced. Distributions. Let's see. Where's our new? So 209. So that seems fine. 209, 209. Remaining equity to use. So that's different. That's going to be total equity plus period 0 cash flow. Then this is going to be this number. That's that. All right. Oh, and then these positions change. So share of the profits, investors is that. Also, cash flow, investors is this number. Owners is this number. Okay, true, 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 true. 11 and 148 should match this cap table. 10.8 and 148.3. We could put a decimal in here. There we go. So that's great. Visuals look fine. No errors. Awesome. Good, good, good. Oh yeah, down here. Okay, this looks good now that I updated the distributions. So 2, 7, and 12. 4, 2, or sorry, 2, 7, 12, 6. And that's 4, 2. Oh, this is not right. Owner, equity. Is that number? And then 24. Okay. I think we're good there. So 8, 9, 10, 12, 5. So that matches. And then 150. Oh, wait. This is not right. 2.6 plus that. All right. Whew. Well, that was a fun morning. We got it all figured out. This is done, and I'm pumped. Next week we'll be doing brand new templates later this week. Now that I finished this today, that was really good, so I don't have to stream it tomorrow. I can do some new stuff, possibly, or I might just take a break, do the overview video. Um, but let's see. I think just checking the tabs here. Okay, so this is good. Distribution to 1 is that one, so B34. So no, there's no check here. Let's put a check on this, which some of these should be 0 against the annual detail. Which it is. So J29 on that. And then individuals, so cap table N57 to R9. Yep, these are good. Okay. Let's do a quick, so we want to make sure these all stay 0. Let's start adjusting the date here and make sure everything still works. So good. Let's try the end year, good, and previous. Okay, so that's all working. Let's see if we don't include terminal value. No. So I'm assuming, let's see, terminal value is probably this. So I need to say if we're not including terminal value, so global control C8 equals no, then 0. Because that means we're not selling the anything. So we're just looking at the forecast as it goes, normal operations, not looking at exit proceeds. Okay, and now it's correct. So that's good. Let's try the end of that year. No and yes, that works. Let's try the last year and with no, and then let's try the very last month. Okay, looks good. Looks good. And if you do zero this out and just assume it's in here, the net gain or loss will offset the cost basis of your vending machines and it'll just flow up into here properly anyway. So if I were to like go 0 here, that 780 just flows right onto this and it kind of nets with the other gain or loss and the other extraordinary income. So essentially it all nets out to be the same as if you just didn't have any vending machine item and you just had it all booked into extraordinary income. So that's fine too. The thing is, it just needs to work with your rational inputs, which it does. All right, this is done. All set. I'm gonna finish it. I'm putting the price down probably to $45. I was testing some pricing on the site, and so I had it at 75. I think I'll put it back to 45 and keep it there. That's where normally things are for a lot of these. I'll do the overview video, update the tabs here, and that's it. And it'll be all set. And then, yeah, we'll keep grinding next week.